Let's trade Disney the T3 way. Starting capital, let's assume 50,000, no margin. We're going to do this on 3 individual positions. December 12th, 2022, Disney's trading right around $94 a share. Let's sell a 90 put strike. The implied volatility is about 36 as of today, December 12th. That's going to bring us in premium of $2.02. And let's assume that the stock closes higher than the $90 strike price. The application lights up certain cells in red, letting you know that you didn't have to take assignment. So we change the outcome from took assignment to expired worthless. How does that look in the metrics? Let's take a look. We can turn on the individual net leg profit and loss. We can turn on the dollar difference, the cumulative premium that we collected, and the outright stock purchase. And of course, the cumulative trade progression. So there's a lot of data there, so let's dissect the 2 most important metrics. Let's turn off the individual net leg profit and loss, the dollar difference, and the premium collected. And all we're left with is the T3 strategy, which is defined as the cumulative trade progression, versus somebody who just walked in and purchased 200 shares of Disney. So at a price of 94, he or she had the stock drop on them down to 91. That's a 3-point loss times 200 shares. The share purchaser is down $600. Investor B, who uses the T3 strategy, sells the 90 put strike. The shares fall to 91, the same as the stock trader, but it does not fall below the strike price, and the share purchaser is down $600, whereas the T3 trader is up $208, or the premium that he or she collected by selling 1 put contract. Let's change the outcome from 91, where the option expired worthless. Let's say it fell all the way down to 87. Now it did not expire worthless, you had to take assignment. If the shares fall below the strike price, you are obligated to buy it at $90 a share, minus your $2 credit, $2.08 to be exact. Your break even is $87.92. So let's change that to took assignment. So now the stock closed on January 13th. These are all 30-day option expirations. So the closest option expiration was January 13th, 2023. Let's assume it closed at $87. The carry forward price the following Monday is $87. What do? We immediately put our shares up for sale. The 100 shares under here, cumulative long shares that were assigned to us, are now put up for sale. Stock closed at $87 on the Friday, the options expiration, right here. The carry forward price is the $87. We're going to go ahead and we're going to sell the $90 call strike. Implied volatility, we'll keep it right around 36. That brings us in $2.43 on a single contract or 100 shares. It's $243, but at the same time, we're going to sell an $85 put strike. Identical to the first step, step 1. We are now in step 2, which is why it's highlighted in yellow. There is a step 2A and a step 2B. It's the only step in this strategy that has a step 2A and 2B. Step 2B is we are repeating step 1, which is we are going to sell the put. We are willing to buy another 100 shares of Disney if the stock falls below whatever strike price you define. Here I've got it defined at 85. We could easily drop it all the way down to 80 if you want to be conservative. Implied volatility, it's only going to bring you in 99 cents per contract, so that's $99. It's just under $100. Just to round it off, let's just bump the implied vol to 37. That pays $1.06 or $106. The reason I raised the implied volatility is if the stock did drop from the starting price of 94 down to 87, that was a 7.45% drop. The probability is high that the implied volatility went up a little bit. So let's go ahead and increase the call volatility as well to 37. So we'd bring in $253 and $1.06, or $253 and $106. And if the stock were to climb, and go above 90, it doesn't expire worthless. And as you can see, the cells are all highlighted in red again, which means something is not populated correctly. Well, if we said that we are selling our shares at $90, that's the strike price we sold, at 93, it is greater than 90, the shares do not expire worthless, they are called away. And because step 2A and 2B are identical steps, a stock, an index, an ETF can only close at a certain or single price on any given day. So we modeled a $93 closing price. Well, $93 is greater than the 80 put strike that we sold. So we did not have to take assignment on the put because the shares were already called away. So those expired worthless. Now let's take a look at how we did versus the share purchaser. In the first step, we were down down $92, and the share purchaser was down $1,400. In step 2A, right here, that's the call sale, we were up $461, and the share purchaser is only down $200 because the shares went from 87 to a hypothetical 93. 94 minus 93 is 1, and the share purchaser had purchased 200 shares, so he or she is down $200. In step 2B, the T3 strategy is up $567, and the share purchaser, of course, is still down $200. But let's make this a worst case scenario again and assume that Disney fell all the way down below 80, which is a heck of a drop. That would equate a 10%, a 10.34% drop from the previous closing price of 87. So a 10.34% drop brings us to 78. And again, we have to change the outcome. The calls were now not called away. They expire worthless. And the put strike, where we said we would buy more shares, an additional 100 shares at an 80 strike price, now we have had to take assignment. Now the application is populated correctly, and we take the closing price on the options expiration for month 2, which was 78, and we use that as the carry forward price for month 3. Now the stock is all the way down to 78. If Disney falls that far, what do? There are no more put sales, only in step 1 and step 2B. Now it is just selling the calls against our 200 shares long. If you ever wonder how many shares you have, it calculates right here. Cumulative long shares at the end of step 1, where we sold the put, we had to take 100 shares. And at the end of step 2, cumulatively, we are now long 200 shares because, once again, the share price of 78, hypothetical, closed below the put strike where we said we would buy an additional 100 shares with an $80 strike price. So all we do now is sell call contracts. So 78 is the carry forward price. Let's go ahead and sell a reasonable strike. Let's just change that here. We could sell perhaps the 80 and get a nice generous premium of 2.79. I'm going to correct the volatility. I'll drop it to 39. Once again, every time a stock falls, the probability is that the implied volatility will rise. So as the share prices are dropping from 94 to 87 down to 78, which is once again was a 10.34% move in that 30-day period, chances are the implied volatility has risen again. So we'll put it at 39. That brings us in $2.70 in premium on 200 shares. We bring in $541. And again, if the application, let's just say it went up 7%, that's pretty generous move. Let's put it to 82. To us, it doesn't really matter. We said we would sell our shares at 80. At 82, the shares would be called away. As you can see, it highlights the cells in red because it's not, the outcome is not correctly populated. You click on the cell, drop it down, now the shares are called away. So now let's see how we did by selling the shares at $80. We walked away with nothing impressive. It's only $108 in profit. But take a look at the share purchaser. The share purchaser is down $2,400. Again, basic math. Stock opened at $94. That's where the share purchaser went in and bought 200 shares at a price of $94 a share. I've given it a hypothetical $82 closing price. That is an aggregate 12.66% drop in share price, and that equates to, let's see, 94 minus 82 is at 12. 12 times 200 is $2,400. That is how much the share purchaser is down. So what does this look like in rates of return? In fact, before we get to that, let's go ahead and we'll war game this one more time. Let's just say the stock made it to 79 and the shares were not called away. We have to turn off those red cells. Options expired worthless. Shares are at $79, and now let's say we really like the share. Maybe some good news came out in the company, maybe a good earnings report, and we're going to go ahead and sell the shares at perhaps $95. I'm sorry, $85 strike price. And the implied volatility, we'll keep it at 39. That pays us $1.48. It doesn't pay us as much because we're willing to try and make some money from going from $79 opening price, and we're hoping it'll go above $85. So let's go ahead and model that out, and we will. Let's just say the stock made a big move, went up 8% in that given 30-day window, and the shares are finally called away. We now have made $1,403 versus the share purchaser, who's still down $1,600. So what does that look like as far as rates of return? So here I've clicked on the rate of return on the at-risk dollars on a step-by-step basis. So we were down 1.05% at the end of step 1, and that's because we had to put up $8,792, of which the market closed down $92. So 1.05% we were down. Then we were down about 7.36%, then down 1.19%. That's step 2A and step 2B. But let's go ahead and annualize those returns, okay? So by clicking the second checkbox, by the time we exited this position with a $1,403 profit, if we can do that, now this is over a 4-month period. So month 1 is step 1. Step 2A and 2B is month 2. Month 3, and then month 4, the market finally rallied. So instead of walking away with a $1,600 loss, we were able to capitalize and make $1,403 in gains. And again, this is a position that has moved against us 16.51% from the starting price of $94 when the share purchaser bought 200 shares, and let's say myself employed the T3 strategy by saying I'm willing to go long the shares, but at a price that I'm willing to pay, which was, in this first step, I was willing to buy 100 shares at $90, and in the second step, I was willing to buy the shares at $80. So it's a very slick way of dollar cost averaging, because with that you get the premiums as well, which even lower your cost more. So there's a number of other metrics here that are amazing in this application. We can go ahead and turn on percentage profit due to premium. So of the $1,403 profit that was made using the T3, 100% of that was made because of the premiums that were collected right here. Okay, now what's interesting is we could swing for the fences, or we could say, let's say the stock once again, which is amazing about this application, you can war game or model and run what if scenarios 5 or 6 months in advance. So let's say it does not exceed the $85 strike. Let's say it gets to $84. Okay, the shares are not called away because we sold an $85 strike price. It only reached 84. We have to correct the outcome from called away to expired worthless. This is a very rinse and repeat type of a strategy. Once again, the closing price on that option's expiration becomes the carry forward price for the next month. So now we're at 84, and let's leave it at $90. Let's say we now think that the stock could make a very generous move to the upside. We get paid $1.75. I'll lower the implied volatility down to maybe 37, so we'll get $1.50 in premium. That brings in an additional $300 on 2 call contracts that we're selling against our shares. And finally, the stock closes above 90, our strike price, and it's at 91. We're still down 1.85% from where we started, and yet the strategy has us making $2,703, whereas the share purchaser, who for 5 months has been stuck in the mud, at one point was down $3,200. I believe that's, yes, it was down $3,200, is still only down $600 by the time that this market rallies. And we're still below where we started. We started at $94, ended at $91. If you had just gone in and bought those 200 shares, you're still down $600. 94 minus 91 is 3. 3 times 200 is a $600 loss. The The T3 strategy is up $2,703. If we were to annualize that out, it's a 23.3% return. And take a look at this metric. This is the percentage of profit. So of the $2,703 made by trading Disney in this fashion, 60.01% of that $2,700 came from collecting all these premiums step by step progressively. And we can turn that on and see that value by clicking on cumulative premium collected. And there it is, $1,703 of the $2,703 made came from premiums collected. How about the dollar difference? Let's click on that. How did we do versus the share purchaser? Let's turn off the cumulative premium so it doesn't get too cluttered. So we made $3,303 more than the share purchaser. The share purchaser was down $600. We're up $2,703 for a dollar difference of $3,303. The individual net leg profit and loss. Each leg shows us how we did step by step. And that's what's really neat about this application is we can dissect this 7 ways to Sunday. And there's a couple of other great metrics, and I'm just going to highlight those right now. Let's take a look at what our risk on our starting capital using the T3 strategy was. And let me just highlight that. We were down never more than 1.67% of our starting capital, which would be the $50,000. By saying I'm going to allocate the $50,000 on 3 different individual securities, such as Disney, and doing a dollar cost average where we sell half the put contracts half the put contracts that we're willing to be assigned on, and the second half if it continues to fall. Using this strategy is a fantastic way to dollar cost average in, not draw down your account in an egregious manner, and still walk away in a far superior way as far as absolute dollars are concerned than if you had just gone in and bought the 200 shares from the outset. So once again, T3 strategy using the TAC trade template. Thanks for watching.